It was stock wipeouts like the recent Billabong debacle that's left retail investors smarting. They've been hurt by companies going cap in hand to big institutional investors and ignoring the effect placements have on their retail stockholders. Now the ASX is moving to ensure smaller players aren't left out in the cold. Emily Mitterhumer has this story.
Capital raising seemed to be good for the big guys, but not so great for the little guys.
Institutions can command a discount, can command an allocation in a placement, but there is no rights offering to existing shareholders, so they are just unfairly treated and they're left out.
Billabong shareholders know only too well how damaging capital raisings can be to small investors. The surfwear company earlier this year sought extra funding, issuing the stock at a huge discount to the trading price for institutional investors. As a result, the stock plummeted nearly 50% in one day. Not only that, but it nearly doubled its investor base, meaning that each share was a far smaller slice of the company.
All those small shareholders are now faced with a share price that has halved and an opportunity to buy more shares at $1.02, and the share price is trading around that level.
Capital raisings can be fraught with difficulty for companies, particularly since the financial crisis. Businesses face the risk that volatile markets may derail their bids for additional cash, and underwriters are demanding deeper discounts on the stock to take on the risk, resulting in a drop in the share price. Currently, companies find it easy to place a parcel of shares with institutional investors and leave retail investors out in the cold.
Certainly, as of the GFC and around 2008-2009, we saw a very large number of institutional placements, highly dilutive institutional placements, ignoring existing shareholders.
And that trend is continuing. Undertaking an institutional share placement has a 3-day turnaround from start to finish, while undertaking a rights issue to retail investors currently takes 26 days. It's clear which is the easier way to raise some additional cash. The ASX is, however, on the case and has issued recommendations on the fairest way for listed businesses to raise additional funds.
Without a doubt, a renounceable rights issue is the fairest way because it allows all shareholders to sell on market.
The regulator says a compressed timetable would encourage companies to raise capital via a rights issue for retail investors, as well as allowing investors to sell their right to buy more shares on the market.
The priority from our perspective for any capital raising is that all shareholders get treated equally.
There's no doubt the current system does not treat all shareholders equally, but now at least the ASX is making moves to give small players their fair share.